Hello, Warriors. Dale Pinkert at TradeGateHub.com. If you saw Mike and my broadcast yesterday, we were trading right at this level in the S&Ps, and we both agreed that we could get another wave to the upside here. It's Fed day. To me, this low is not going to hold. Not just because I might have an opinion of being bearish or bullish, but because of my work of this being a confirmed low, markets rarely bottom when momentum. Look at this RSI reading on the 2-hour, 1884. So I'd expect one more low and then a better rally. So Ellioticians would call this a wave three ended, and we're in some type of wave four now. It could stretch. I don't think we should do better than 45.20. And, right here, we could look at the 200-day. That is a little bit above the S&Ps right here. This might be a tough area, the 44.40 level. But looking for one more low, in my view, this was a very significant break. We talked about this level, going back to a few weeks ago. Right here, this was a bull bear line when we were still in an uptrend. And even though NASDAQ was breaking, S&P was holding. I said, but this is your line in the sand. It was 47.5. And then there were two videos saying that this was a retest of the breakdown. You had two opportunities to short it. Maybe you did better than me because I thought at first we were just going to pull back and then get another high. Turned out to be a crash. And if you want to hear a funny story that wasn't that funny, is my computer crashed Friday and was still down Monday. So I came in and asked people if I missed anything. So, it's not late. If this is going to be a true bear market, I brought in some guys that, are looking for much lower levels. In fact, some of the analysts that I have interviewed are saying that, this first stop down here is 3,300. And what we could do is we could build a right shoulder here if this low is going to hold, but closes back under 42 measure minimum, just as this is a 600 handle break, that it'll measure 3,600 down here, 600 on a breakdown under Monday's low. One comment I heard, the hedge fund managers are having a meeting, and after the reversal that we had on Monday, this candle, they were saying, oh, we are all so relieved. Well, if they're counting on this being the low to end the break before we get a rally to new highs, they won't be as relieved. They should be protected. So we have the Fed today, and I've been waiting for, it feels like eternity now, for the dollar to resolve itself. And it looks like it's trying to roll over here, lower low. I'm still looking for that spike and one more push, a terminal thrust to the upside, because this is a wave four triangle. I'm not an Elliotician, but I learn and I'm starting to recognize a few things. And even if I wasn't, I always thought that we would get one more push higher in the dollar, because the dollar did confirm at the highs up here. The way I see the dollar is something I described, is that we've taken out all the longs, all the dollar bulls are gone, and the dollar bears had a nice little victory for a while. And I don't care if you're a bull or a bear, if they didn't pull the trigger and take some profits down here, they had to give it all back and see if we could retest these lows. So I'm still in the camp that I don't think the Fed is going to cave and sound less hawkish. Believe that this is what they want to accomplish, cooling down speculation in stock markets, eventually real estate markets, and until there's an accident. So no reason after 10% correction in S&Ps and 17 in NASDAQ for them to come off their mission of tapering and eventually tightening. So I think bulls might be disappointed in the next few days about the Fed put bailing them out after this correction. So getting to some other aspects of the dollar, the euro is, one of the most boring range-bound markets. Same thing all the way since Thanksgiving. We had a low down there, basically the inverse of the dollar. We've shaken out all the euro bears, and now we have to take care of business with the euro bulls down here. I'm looking for 111 110.50, excuse me. Hope it's not COVID, and still think that's going to happen. I'd still be, last week I was saying I certainly wouldn't buy cable up here. I'd look for a pullback to 34.5. It got to 34.30. I think this high is going to hold in cable as well, and we're going to retest the lows. Japanese yen, I was very impressed after having no charts, and going through withdrawals without any charts with all this historic action, that the yen didn't even take out the prior week's low Monday with all that risk off. And to me, it looks like perhaps this wasn't a 1, 2, 3, but this is where you start the count for 1, 2, and I still think there's a shot for new highs, which, you look at what happened with yields. They came off maybe 10 bips from the highs, but I wouldn't say that they really caved with the sell-off that we had in the market. Pulled back from this 187 level, 185, 86 level to 170. And this still looks poised with a confirmed high to make its move towards potentially 2%, 210. And there's some liquidation going on in the gold market in front of the Fed. And to me, that's a pretty negative candle. And I think you could, everyone's waiting for the breakout to the upside. And what a tough trade. Wouldn't this be a tough trade with 180,000 Russian troops on the Ukrainian border, and the US sending 8,000 missiles? And, is Putin going to wait for NATO to reinforce Ukraine, or go now? Or maybe he doesn't want to, Xi to call him up and yell at him for starting the war in the middle of the Winter Olympics, which I've heard from the athletes is a real stressful experience just to get in there on television. But I still think there's a shot down for 1720. I think you could take a shot at being short with stops over these highs. It could be down here $100 break in a hurry. The silver was acting weaker before gold, has a much weaker chart formation. Okay, so gold had already taken out this high, and I still think there's one more flush left in silver to take out this double bottom at 2140. And at new lows, once divergences begin to build, I'll be looking at silver and gold and the miners. And, keep in mind what Tavi Costa showed a few weeks ago was the gold Dow ratio. And that was before the big sell-off we had. And, gold was respectable, right? It may break now, but it sure held up much better than the market in the past few days. In fact, it's one of the few markets that had a bid. Okay. And let's see. So looking at what's happening here in Aussie, it's one of the stronger currencies right now, but gold, I'm bearish. Okay, I'm bearish. I'll take the chance of, I wasn't short, I wasn't long, but up here, I think you could take a bet on the short side, but manage your risk, $20 stops or so. And then I wanted to show you Aussie, which has been pretty stiff here. the last week or so, but you know, we never got up to this 74 level because of risk off and Aussie's trying to hold. But if you look at the bigger picture in Aussie, it still looks to me like we could make one more low. I don't know who put up all these lines, but I'm looking for, you know, 68.60. I still think Aussie's in trouble. That ties in with weaker commodity, mainly metal prices, copper prices. Copper hasn't been acting that good. It doesn't act great when there's market corrections of 10 to 15% because it's an industrial. And I think those are a lot of ideas to consider into the Fed. So I don't think the Fed is going to, Paul is going to sound dovish. And I think that the dollar could have one more hurrah to the upside above this 97 level and clean out the bears and head maybe towards the 98. And this will be a level I'll be looking to fade dollar strength and start looking at other fiat currencies. And by then, perhaps gold's at the buy zone, silver's at the buy zone. That's my plan. Doesn't mean it's going to happen, but that's what I'm thinking here. And be careful with what's going on here in the S&Ps, even though we're rallying here. I don't believe that yesterday's low is the low or even a good low. But once we take this low out, maybe trade 4,100, I think you could probably buy it because then we'll get some type of wave two, fib retracement of the whole decline. So say we break to 4,100, big round numbers, that's about a 700 handle move. So you could get a 400 handle retracement at 61.8, and from 41, that's going to take you back to the breakdown around 45, 45 and a half. This, I think, will be your next good selling opportunity. Not that this isn't a great trade if it just falls apart from here and goes to 4,100, but I'm thinking, you know, we're completing the first wave down. And the key to knowing whether or not a market is, and this would be different than the last decade, that if we get a rally to 4,500 after one more low, and it's a failing rally between here and, you know, 46, and then we take out whatever low we're going to make here in the next several days or weeks or 24 hours, that would be the first failing rally in quite some time. There will be another entry for shorts. I don't think you have to have FOMO for anything. And you know, if not, there'll be something for you to do in the gold, or there'll be something to do in oil, or there'll be something to do. There are many rides in financial Disneyland. Okay, there are many instruments, and you don't have to follow as much as I cover here in these broadcasts. And I would be reacting to the Fed or just sitting on my hands and let the dust settle after what's happened here in the last few weeks, and have the Fed, and we also have Ukraine. So, you know, I know that a lot of people are piling into gold. It almost seems too obvious to me, buy gold and you're going to make money because there's going to be an invasion. You know, maybe Russia's going to have to sell some gold. They're big gold holders. Maybe this is not free. It's not free to support this type of military operation, which is the biggest military operation on land since World War II. In fact, the number of troops they have there, I think, are more than the Americans had on D-Day. So, you know, I think it's not a question of if, just when. And I wouldn't be real aggressive right now with positions, and pick your spots and reduce a little leverage, because I think we've entered a new regime of higher volatility, not just in the stock market, but across most asset classes. Tomorrow I'll be with Adam Button. Adam with Forex Live has been on a fairly consistent basis giving us his look ahead into January into February. I remember when he was on, he said January was going to be a great month for gold. And it was a great month for gold. And then when I was talking about risk off, he was talking about how a lot of people were parking, crypto people were parking their money in FANGs. So, you know, if that's what they were doing, they took a double whammy, because if they were in FANGs, the only one that really held up well was Apple. But we all know what happened to Netflix, right? And Amazon. You know, even Tesla backed off to 850, right? So they may have learned a lesson in the flight to quality when you want to come out of risk, like Bitcoin, which almost got to a number I talked about on the video, 32,000. I know it's recovering with the market here. Let's see where you are, Bitcoin. There you are. Yeah, nice rally. But we got pretty close to 32 grand down here. What was the low? 32.9. So I was off by a grand. Don't chase it, because if we have another risk off episode, it doesn't look that much different than the S&P chart, right? You're getting a nice little rally. We could still have new lows in Bitcoin. The difference is on Bitcoin, well, not on the daily, but at least on the 4-hour, at least we had a little divergence, and it was the first one to turn on Monday. So maybe we have something new for a market tell, is that crypto might turn back to the downside before stock indexes. So it's just become another risk asset. That's the way it's behaving. So I think there's a lot of market cap that has disappeared in equities and crypto. And I think there's going to be more market cap that's going to disappear from equities and crypto in the months ahead. Why can't we have a 6-month correction in the S&Ps and have a 30-40% correction while the Fed tries to get through to normalization? The economy can be running okay and the markets could be crummy. There have been many times that the economy was crummy and the market loved it and increased in value. So don't tie in what you're seeing in the economy with what is happening on your screen. At times they diverge in direction. So we could have a bear market or a correction in equities and not have a recession. Okay, so just trade what you see. If this is helping you achieve what you're trying to accomplish as a trader, we're glad of that. Invite you to join us here on TradeGateHub.com. Mike will be up in an hour and 15 minutes to give you a review, and you should be listening to Mike, because I still hear his voice echoing in my head all last week before my computer crashed. And he was telling people in our trading room, in our main chat, don't be a hero. And hopefully people heeded that and didn't start buying last week before we had the bloodbath on Friday and Monday. So good hunting, everyone. See you tomorrow with Adam. Remember, don't just count your pips, count your blessings. And I'll see everyone tomorrow. Adios.